So today we're going to talk about three stocks that are making big moves. These are companies that reported earnings in the last 24 hours, and I thought we'd talk about them because they're really interesting stocks. Now, I know I was going to talk about a brand new stock I bought because in the last couple of weeks I bought two brand new stocks, and I was going to talk about one of them today, but I thought I'll save one of them for Friday because that'll be a really good Friday video for the weekend, and the other one I'll probably talk about next week before I do the stocks that I'm buying. So I will get around to that. I just thought I'd knock it back because these three stocks are worth talking about. And the first one being Hollywood Bowl. So most of you guys know this has been a channel favourite for quite a long time now. First started buying this in 2020, so being a shareholder for this for about 3.5 years now, which is quite crazy to say that. But yeah, I've been a shareholder for this one for about 3.5 years, and I'm currently up on the position around about 40%, excluding dividends, because I have collected obviously a few dividends over the last kind of 3.5 years. But if realistically I held my shares from the time I started buying them, I'd probably be up 70%, but I'm up about 4% because I've been averaging up on the position because I really like it. I think the financials keep improving, and I think the valuation is relatively cheap for a company that is doing these financials and also paying nearly 5% dividend yield as well. Now today the stock is currently up around about 2.5%. It was actually up over 5% when it opened up, but it's having a bit of a pullback today, and it's a little bit frustrating because realistically, these earnings were really good. We had expectations they were going to be good because we saw a rival, which is the UK rival, which is 10 Entertainment, I believe it's called. I actually don't know the actual trading name, but Tenpin is the name they go under as the locations. We saw them bring out really good numbers, so we were thinking, well, Hollywood Bowl's probably going to do the same thing, and they did. They were really good numbers, and I'm going to go through those earnings in a little bit, but realistically, the stock should have been up 10% today on these earnings. When you look at the valuation and the earnings that they brought out, this stock should have been up 10% when you look at the valuation. It's absolutely crazy, and it's frustrating, and I want to really quickly make a point about this because I can see there's a few people getting a little bit frustrated because you look at a lot of stocks at the moment and stocks are not really moving. They're bouncing around a lot and they're not really moving in an upwards direction. And I've said this for a while, like, people have got to realise we haven't had a normal market for 3 years. You know, exclude the 7 big giants out there that are making the S&P look better, and I've seen a lot of people mention before about the S&P 500. If it wasn't for them 7 stocks, even the S&P 500 would not look that great at the moment. We haven't, for everything outside of the 7 big stocks out there, the big 7, the magnificent 7, we haven't had a normal market. We haven't had a normal market for a long time on a lot of small market caps, a lot of UK stocks. And Hollywood Bowl is a prime example. You look at Hollywood Bowl and it IPO'd, I think 2016. And you look at when it IPO'd, stock was a little bit flat after the IPO, as it normally does, because normally you come onto the market for a bit of a premium. So it has a little bit of catching up on that valuation that it IPO'd at. And then eventually you'd expect a little bit of movement because it is the stock market, a little bit of volatility. But as earnings grow, the share price normally reflects the earnings growth and normally have a nice steady uptrend on stocks normally as the earnings grow. Granted, sometimes there can be them little volatile dips because it is the stock market. You know, you'd look at that time frame there and you go, the stock dropped 21%. Has the stock reflected a 21% drop in revenue? Has it reflected a 21% drop in earnings? Probably not, but that's the stock market. Sometimes those crazy volatile drops can happen. So you can still expect them. But if you look from a zoomed out point of view, that only kind of lasted a 4-month period. And apart from that, the share price reflected the earnings growth, and especially in 2019, that was a really good year for Hollywood Bowl. Now you look at the share price here, just look at the volatility that we've had in the last 3 years. Massively down, massively up, flatline for ages, then down another 35%, then we go up to 51%, and then we're having drops of, big 10% drops down here. We've got nearly another 18% drop here. It's bouncing around. This is the volatility that's been in the stock market the last 3 years is absolutely crazy. And as well as that, the share prices haven't reflected the company's improvements. If you look at Hollywood Bowl here, the share price reflects the financials. If you were ever to look at the valuation or the earnings and revenue growth of Hollywood Bowl in that time frame, just look at that. You had steady revenue growth, steady profit growth, and that reflected in the share price. Now, granted, we had the CV drop that happened, so you can expect a little bit of volatility in that share price there. But apart from that, it's been a very consistent rebound out and a very good boom out of the CV situation with revenue and profit growth. And you look here right now, if you look at the financials before the CV situation, this company was putting in 132 million. It's now putting in 203 million. So that's a nearly 70 million increase on the revenue. You look at the profitability, 21 million in profit. Right now they're doing 31 million in profit. Same again, that's nearly a 50% increase, 10 million plus increase in profitability. So if I were to show you that on a share price point of view, would you expect Hollywood Bowl to be valued more or less than where it was? You'd say, well, it's going to be more. So then when we flick out to the stock chart once again, you look at where we peaked before the CV situation, the stock's down 22% since that time frame. The stock is lower than where it was 3 years ago, even though the profit's up 10 million and the revenue's up 70 million. Like, guys, this is the stock market we're in. It's frustrating and it's annoying and it doesn't make sense, but that's the market that we're in. Even if we take out that big surge up in the share price there, if I just go from like the 8th of November 2019, which by the way, then we are going to 4 years ago, the share price is flat from 4 years ago, even though the profit is up, 10 million, a third, and the revenue is up, 70 million. It's crazy. Like, realistically right now from this point here, we should see, apart from the CV drop, we should see a nice upward trend in this stock, but it's not happening. And that's the stock market, guys. It's not been in a normal market for a few years. It eventually will get to a normal market, but it's not happening right now. And it's like a company like this, this is a company that is doing absolutely amazing financials, absolute killer balance sheet. And it's 13 times earnings, and you're picking up a 5% dividend yield. Consistent 5% dividend yield, very good balance sheet, 13 times earnings. This company should be the market average valuation. This is what it used to trade at, the market average valuation of 18, 19, 20 times earnings. This should be a lot higher than where it is right now, but it's not. And it should be, the valuation should be 50% higher than where it is right now. And then you're not factoring in collecting a dividend and also the growth it's going to have. And that's where we're at, guys. That is where we're at. I keep trying to remind people, because some people are getting a bit caught up. Some people are getting frustrated that shares are bouncing around so much, or shares aren't really doing anything, or shares are going down once again. You think this is the rally and then it goes back again. And also looking at something like maybe the S&P 500 and go, well, the S&P 500 is up this year. Well, apart from that Magnificent Seven, the market hasn't, and I would say that even that's not a normal market, because their valuations are absolutely crazy. But outside of them, it's not been a normal market for 3 years, guys. And Hollywood Bowl's a prime example of that. This stock should be right now, should be higher than where it was before the CV situation. Should be at least a £3 stock. Should be probably even more than that. Should be maybe even a £3.50 stock now, factoring in the growth that it's had. But it hasn't reflected it. And it can be frustrating, guys. Anyway, getting on to the numbers though. The numbers were really good. Obviously, I know most of you guys probably know Hollywood Bowl. Obviously, you can go for the put stars, which is the mini golf, or the actual bowling. In the actual bowling alleys, they have arcades as well. And they also have bars and restaurants. Maybe when I say restaurants, maybe not the normal restaurants, but they do, a little bit of finger food, hot dogs and, fries and all that. So yeah, really good locations, put them in next to busy places in retail parks where you might go to cinema, might go shopping, and then you go bowling, or you might go for a bit of food, or you might pop into the arcade. So they always put the location in really good places. Obviously expanding into Canada as well. Seeing there's a fragmented market in Canada, and they reckon they can take a good share in the Canadian market as well. I mean, look at the numbers. 11% revenue growth, double-digit growth, which is absolutely amazing. UK growth, 2.7%. If you take out the VAT rate, it's actually 7.7%. UK overall up 4.1%. The Canada expansion up 15%. EBITDA to be ahead of expectations. 3 new centres opened. 83 centres now have the pins on strings, so they don't need to employ a mechanic to fix the alleys in case they break, and that's obviously saving them money as well. The Canadian expansion continues to do well. 9 centres operating now, and an Ontario centre due in H1 2024. And also they're going to add in 10 centres over the next 5 years, and also 30 sites in the next 10 years. So a good growth plan there. Look at those numbers are absolutely fantastic. That's absolutely fantastic numbers. And yet you have a company trading at a below market valuation with a 5% dividend yield, and that's where we're at. Netflix reported their numbers. The stock is currently up 12% in pre-market, which is pretty good going. Looked at the numbers, I was surprised. I looked at the numbers and I thought, these are really good numbers. I'm not surprised to see it jumping so much. And this comes off Netflix, which once again was referred to only a year ago, maybe even a year and a half ago now, was referred to as a dead company, and everyone said that's Netflix peak's kind of gone, and obviously it had a bit of a rebound there. And you look at these numbers, and they are pretty impressive. You look at the numbers. The EPS was, the total ads were impressive. They came with 247 when the expected was 244, which was really good. Revenue as well grew 7.8%, and the earnings per share came in at 373, beating the forecast of 348. So yeah, not surprised to see you jump off these numbers. When you come in with these sort of numbers, you would expect them to reflect that on the share price, and shows you how quickly a sentiment can change around a stock. We've seen the same with Meta, and you'd say that if you are someone that is maybe a Disney shareholder right now, if you ever wanted proof how quick things can turn around momentum wise and numbers wise, you'd point out Netflix. I would say that I'm quite surprised by the numbers. I don't know if it helps that we're going through, Hollowball obviously doing very good numbers in a living crisis. Netflix, maybe that we're going through that cost of living crisis, that everyone's kind of stayed home a little bit over summer, and maybe people gone, because we're at home, let's get our Netflix subscription back, as well as the the crackdown on the password sharing coming in as well. So maybe that's the factors of it. I mean, I looked at the content. I don't think the content has been many standout things in Netflix compared to the last couple of quarters. I think last couple of quarters, you had like Wednesday, the Jeffrey Dahmer, and Stranger Things. So don't think there's been any standout pulling series that's maybe helped that demand, but maybe that's the reason why. So really, really good numbers from Netflix. I'm not surprised by that one at all. Next one, Tesla. I can see all the Tesla shareholders and the fanboys in the comment section going, I'm getting ready to type it in the comment section already. They don't like me talking about this one. They get really upset. But yeah, Tesla, I mean, we talked about this one on Monday. The numbers, we were worried about them, and we were right to be worried. In my opinion, this stock should have been down over double percentage. This was a terrible. This is one of the worst earnings reports I've seen Tesla do. And if I was a Tesla shareholder, I'd be worried with these numbers. Not from a point of view that the company is bust in the next 5 years. I think that they're still going to be okay in the longer term. But the high interest rate environment is kicking the sales. And the fact that it trades at 68 times earnings with these numbers, I would be worried, because I think that this valuation could easily be slashed in half to reflect that inflationary pressures. So from a short-term point of view, I think that this is in trouble. Long-term, I still think Tesla's okay, but short-term, I think that this is going to, some point reflect in the share price. When you look at, the last year, and the stock is only kind of down 17%, it's a bit like, come on, you're sitting that close to 52-week highs. Every other kind of high interest company that's been affected is down like 50+%, and I think it's a matter of time before it gets this. I think Tesla does have that kind of cult following, and without sounding too harsh, I believe a few people that invest in Tesla do not really know what they're investing in, and that's maybe what's helping them kind of the share price to stay up a little bit. But eventually, I think that's going to show in the financials. I mean, just look at this. I mean, the actual showing in the share price, automotive revenues down up 5%. I mean, that's terrible growth. I mean, energy generation, fair play, was actually very good. Service and revenue once again held up pretty good. But the revenues is when that's your major part of the business. That's obviously a little bit of an issue. I mean, total revenues only 9% growth. I think actually next quarter, I think it's forecast to drop down to I believe it's actually 7%. Yeah, next quarter is actually forecast to drop to 7% revenue growth. So I think that's way too low for Tesla. It's far off that 50% target Elon Musk set out only a year and a half ago. I mean, you're talking the fact that National Express is growing faster than this, Walgreens is growing faster than this, K-Box is growing faster than this. Obviously, that's not good. The big thing though is that obviously revenues can be held up if you sell your product for cheaper. Sell the same amount of cars, but you make less money off them because you bring your profit down, and that's what's happening as well. So they have a double whammy that they can't hold the revenues up anymore. They're struggling to hold up the revenues up and bringing down the amount of profit they're making off every vehicle. Total gross profit down 22%. GAAP gross margins down 719 basis points. Adjusted EBITDA down 24%. Income from operations down 52%. Free cash flow down 74%. I mean, every number there. I mean, obviously take out the energy generation, which fair play, that was actually really good. Take out that, the problem is it doesn't make a big enough part of the company at the moment. You know, a lot of weak numbers out here. I mean, at first I was like, when the numbers came out, the share price actually didn't drop off the numbers. It was actually slightly up, and I was like, wow, like that's impressive. The shares to hold up that much after them numbers. Originally, I was like, that's them numbers for me. You know, when you're missing EPS and the revenue, how they did, I was like, and then you're looking at the drop in numbers and the gross margins. I was like, that's already a big drop. And then it actually got towards the conference call, and I was worried once again listening to the conference call. I was like, this is a bad conference call. So they talked about the ramp up in the Cybertruck, and it didn't sound good. You know, they talked about that it's not going to be cash flow positive for a while. They're going to have challenges ramping it up. It's not going to be cash flow positive for like 18 months, which isn't good, which you can see here. They said that they're only going to roughly ship 250,000 units, which I was like, and that's not until 2025, which I was like, that's not good as well on your new product. So you've got a new product here that is probably not going to see you cash flow positive for 18 months, that you only can ship 250k units out until 2025, which isn't good. And then Elon Musk, I mean, obviously he does a good job of talking up the company, and he's probably one of the best talkers in the game when it comes to the conference calls. But the one thing that kind of worried me is that he came out and said that it's his suggestion that the company will grow at 50% going forward. He came out and said, oh, it's not going to grow 50% forever. And I was like, well, we know the company's not going to grow 50% forever. The only problem is that you can't come out and say that it's not going to grow 50% going forward now, after you only said that a year ago. In fact, I think even, as you can see here, as it reflected in this article, in the January earnings, on the 25th of January, he once again confirmed that the company's going to grow 50% going forward. And it's a bit like, you know, when you've only made this target up about a year and a half ago, when you only said that at the start of this year, and now you're going back and saying, yeah, we can't grow 50% forever. It's like, well, fair enough if you said that 3 or 4 years down the line, but this was only recently when you came with this target, and you only said this at the start of the year. Like, this is pretty bad for you to go on it right now. Like, if I was a shareholder, I'd be like, he's trying to prepare shareholders that things aren't going good out there at the moment, and to try and go back on what he said. And we've seen Elon Musk, you know, say this multiple times. We've seen him say, oh, the Cybertruck's going to be easy to ramp, and then it comes out, oh no, it's not actually going to be easy to ramp. We've seen it with the full self-driving, and we've seen it with the, you know, many other times that he's a very good talker, but when he comes to the delivery, sometimes you're like, yeah, he's a good salesman, but some of the things that he said aren't really showing. And I thought, you know, looking at what was said in there, I would have walked away from that conference call quite negative. And just to show you like the change in direction for Tesla in the last kind of 12 months. So this is currently the current forecast for Tesla. If I actually drop back to January this year, if we look at, say, the revenue growth for this year, so you can see here they're currently expecting 21% revenue growth. At the start of this year, it's actually 28%. So there's a big 7% downgrade on the revenue growth alone this year. If you look at the 2024, we were expecting 23% growth now. At the start of this year, we were actually expecting 31% growth. We've had a 10% guidance cut on the revenue for last year. If you look at the EPS side of it, the average EPS for a year ago was $3.32. If you look now, or a year ago, it was $4.17. You nearly had a $1 downgrade on the EPS guidance, which is crazy. So, you know, you're seeing a big downgrade from where we were a year ago. And, you know, this screenshot that I took is currently from the 26th of January 2023. And if you were to go back to the share price a year ago, so if we actually go to the 26th of January 2003, the share price is actually up 51%. So we've seen the guidance cut by 7% this year, 10% next year. We've seen the EPS downgrade by $1, and yet the share price is up 51% since that time frame. And this is what I'm talking about. Like, Tesla's one of the Magnificent Seven that we spoke about earlier in the video. You know, this is a stock that is breaking the trend of what other stocks are doing. This stock is up a lot, even though the financials have deteriorated, which doesn't make sense. And I looked at Tesla's earnings last night, and I don't know how this stock is only really down in the last year. Is only down, you know, 17%. You know, for me, looking at those earnings, and the miss on EPS, the miss on revenue, the downgrade on EBITDA, cash flow, the growth, growing slower than Mobico Group and Catebox. And you look at the downgrade for the full year, where the expectations for this year and next year, and you look at the downgrade that's happened, I don't know how you can justify this valuation. I still think Tesla will be very good in the long term, in the next 4 or 5 years, but I just think you're paying nearly 70 times earnings for a company that's downgrading this guidance. The numbers and the profitability is deteriorating. The revenue's slowing down rapidly. And granted, it's a high interest rate environment, and I don't think this will happen forever, but surely there's got to be more reflection in the share price than what it is right now. You look at a lot of other high interest rate environment companies and how much they've been slammed with these sort of financials. I don't know. I'd be worried about Tesla, and I think that it's only a matter of time that the share price starts reflecting it, because I think of those numbers, this stock should have been down 10% yesterday, at least. And realistically, I think the stock should be at 52 close right now. So we'll see what happens, but yeah, I'd be worried if I was a Tesla shareholder. So I thought I'd just talk about them 3 stocks. Good numbers from Ball, good numbers from Netflix. Worrying numbers from Tesla is my opinion after last night, but hope you enjoyed the video. See you in a bit.